Hello everyone, John AG here. Welcome back to my channel Aurex. If you haven't yet, subscribe to my channel. In this channel, you will find the real information, real market updates that everyone cannot tell you. So please subscribe to this channel, and I love you, all of my subscribers, for your support. And please watch this video till the very end, because YouTube will not push my videos to more people. There is a quiet, almost imperceptible tremor running beneath the surface of the global financial system right now. It is late May of 2026, and while the mainstream media is obsessing over the latest political theater and the endless debates in Washington and Brussels, a tectonic shift is happening in the physical world. It is happening in the vaults of London, the massive industrial parks of Shenzhen, the deep, sweltering mines of the Andes, and the algorithmic trading desks of Wall Street. Something profound and frankly terrifying for the unprepared investor is unfolding in the precious metals market. If you have your life savings tied up in hard assets, if you have spent years diligently stacking wealth to protect your family from the ravages of inflation and currency debasement, you need to listen very carefully to what I am about to tell you. Silver, the historical bedrock of human commerce, the so-called poor man's gold, and the absolute lifeblood of the 21st century green energy transition, has just flashed a massive, undeniable warning sign. They look at the charts and see a simple price correction. I look at the supply chain and see a structural fracture. To understand the magnitude of this moment, we have to travel back just a few short months. Do you remember the absolute euphoria of January? It feels like we lived a lifetime in those few weeks. At the start of this year, the world was gripped by a financial mania that we had not witnessed in generations. Gold was breaking through the unthinkable $5,000 barrier, acting as the ultimate barometer of global anxiety. But silver, the asset that had tested the patience, the sanity, and the resolve of retail investors for over a decade, finally shattered its chains. We watched, absolutely mesmerized, as silver breached the psychologically impossible $100 mark and skyrocketed with blinding speed to a blistering $120 per ounce. Think about how that felt. Think about the millions of retail investors, the grandfathers who had been locking away American Eagles and Canadian Maple Leafs in their home safes for 20 years, enduring the mockery of stock market speculators. Think about the young, aggressive traders who poured their limited capital into physical bullion, believing the promises of an epic, world-breaking short squeeze. When the price hit $120, it felt like profound vindication. It felt like the long-promised structural shortage had finally broken the back of the institutional paper manipulation. The narrative was absolutely perfect, almost intoxicating. The world was running out of silver, the green energy transition demanded every single ounce in existence, and the fiat currency system was burning to the ground. But euphoria is the most dangerous drug in the financial markets. It acts as a blinding agent. It makes us forget the cold, ruthless, and unforgiving mechanics of industrial economics. As we sit here today, in the final days of May 2026, the reality has set in with brutal force. The price of silver has cratered back to the mid-70s. It has surrendered over a third of its peak value in a matter of months, leaving a trail of decimated portfolios and broken spirits in its wake. And while gold has experienced a mild, respectful cooling off, settling comfortably around the $4,544 mark, silver has plummeted with violent, alarming velocity. We recently witnessed a single grueling week where silver dropped a staggering 12%, while gold barely flinched, dropping only 3%. That massive gap in performance is not a random market anomaly. That gap is the warning sign screaming at us from the ticker tape. To decode this warning, we must dissect the incredibly complex, dual-natured personality of this miraculous metal. Silver is caught in a perpetual, agonizing identity crisis. Gold is beautifully simple. It is almost entirely a monetary asset. It is a psychological safe haven, a bedrock of central bank reserves, a Tier 1 asset recognized by the Bank for International Settlements, and a pure, unadulterated hedge against human folly and sovereign debt spirals. When the world is afraid, when the geopolitical map is burning, gold stands its ground like a fortress. Silver, however, suffers from a deeply split personality. Yes, it possesses thousands of years of rich history as money. Yes, it was the currency of empires, from Rome to the Spanish galleons. But in the hyper-advanced, technologically ravenous world of 2026, silver is no longer just money. Roughly 60% of all global silver demand is purely, ruthlessly industrial. It is the most conductive metal on the periodic table. It possesses unparalleled thermal conductivity and light reflectivity. It is the invisible blood running through the intricate veins of our electric vehicles. It is the critical component in the high-efficiency semiconductors that are currently powering the artificial intelligence data centers expanding across the globe. And most importantly, it is the absolute backbone of the global photovoltaic industry, the solar panels that are supposed to save the planet. When global fear rises, silver tries desperately to run with gold. It puts on its monetary hat and attempts to act as a safe haven. But when the cold, hard industrial realities set in, silver is violently yanked back to earth, tethered inescapably to the brutal laws of manufacturing, supply, and demand. Let me introduce you to the most critical, unforgiving concept of commodity economics. The cure for high prices is high prices. When silver hit $120 an ounce in January, it was a moment of profound wealth generation for the investor holding a 100-ounce bar in their living room. But I want you to shift your perspective. I want you to imagine you are a supply chain manager at a massive Tier 1 solar panel manufacturing plant in Shenzhen, China, or perhaps a new facility in Germany or the American Midwest. The profit margins in the solar industry are notoriously, painfully thin. It is an industry built on hyper-efficiency and scale. Photovoltaic cells require a very specific, highly refined silver paste to conduct the electricity generated by the sun. It is a non-negotiable component. When the input cost of that conductive paste tripled in the span of a few months, these manufacturers were not celebrating. They were staring down the barrel of total, catastrophic bankruptcy. They were faced with an existential choice: shut down the production lines and let the company die, or engineer their way out of the crisis. Human ingenuity, when backed into a corner, is a terrifyingly efficient force. They chose to engineer their way out, and they did it with a speed that caught the entire financial world off guard. This is the phenomenon known as thrifting. In 2026, the high-level institutional analysts on Wall Street have coined a more chilling term for it: De-Silverization. Institutions like Bank of America and UBS have recently released stark, sobering reports that should be required reading for anyone holding precious metals. They noted that the incredibly high prices of early 2026 forced global manufacturers to accelerate their thrifting processes at a breakneck, unprecedented pace. The engineers went into overdrive. They developed new, highly advanced copper-silver alloys. They refined their screen printing manufacturing techniques to micrometer precision. They systematically, ruthlessly reduced the amount of silver required for every single solar panel rolling off the assembly line. The Silver Institute, the world's premier authority on the metal, recently released their 2026 World Silver Survey. The data hidden inside that report is the smoking gun. They are projecting that photovoltaic silver demand will actually fall by an astonishing 19% this year. I need you to pause and truly absorb the magnitude of that statement. The world is currently building more solar panels than ever before in the history of human civilization. Entire nations are transitioning their grids. Solar installation capacity is projected to expand by another 15% globally this year. Yet, despite this massive explosion in physical output, the industry is buying significantly less silver to accomplish it. For the better part of a decade, the entire bullish thesis for silver, the reason you were told it was going to the moon, rested on a massive, perpetually expanding structural supply deficit. At the start of this year, the most respected analysts were predicting a staggering, almost apocalyptic 300 million ounce physical shortfall. They told us the vaults would run dry by autumn. But because of this rapid, desperate demand destruction engineered by the solar industry, that massive deficit is actively collapsing. The projections have been violently revised. We are now looking at a deficit that is shrunk by up to 90%. The shortfall for 2026 may be a mere 60 to 70 million ounces. In the cold, clinical words of the institutional banking analysts, the global silver deficit has become so small, so fragile, that even a modest wave of retail investor selling, people capitulating and liquidating their stacks, could instantly flip the entire global market from a severe shortage into an outright surplus. That is the flashing red warning sign. The absolute structural foundation of the grand silver bull market is eroding beneath our feet, washing away in the tide of industrial innovation. But here at Aurex, we do not just stare at spreadsheets, data terminals, and institutional white papers. Finance is not just numbers on a screen, it is human energy, sweat, and the physical limits of the earth. We have to look at the other side of the equation, the deeply human reality of the global supply chain. Is the physical silver supply currently tight? Absolutely. Do not let the shrinking deficit fool you into thinking silver is suddenly abundant. We are currently navigating our 6th consecutive year of a structural supply deficit. The above-ground, easily accessible inventories have been methodically decimated over half a decade. The free float at the London Bullion Market Association, LBMA, the actual metal available for delivery, has dwindled to a precarious multi-year low of roughly 136 million ounces. But you have to understand why the supply is tight, and why it cannot simply be turned back on like a faucet to save the market. If you travel deep into the primary silver-producing nations of the world, the rugged terrains of Mexico, the high altitudes of Peru, the vast expanses of Australia, you will witness an industry that is literally struggling against the physical limits of nature. Imagine the life of a miner in Zacatecas, descending thousands of feet into the sweltering dark of the earth. The era of finding massive, high-grade veins of pure silver is over. Those easy deposits were mined out a century ago. Today, the mining industry is dealing with aggressively declining ore grades. To extract the exact same single ounce of silver they did 10 years ago, these companies must dig deeper, blast more rock, move millions of tons of useless dirt, and expend drastically more diesel fuel and electricity. Furthermore, the geopolitical friction surrounding extraction has reached a boiling point in 2026. Local communities, deeply concerned about water tables and environmental degradation, are fiercely pushing back against mining expansions. Securing environmental permitting for a new mine is no longer a matter of months. It is a grueling, decade-long legal war of attrition. But the most critical factor, the Achilles heel of the silver supply, is the byproduct dilemma. Roughly 70% of all the silver mined on planet Earth is not mined on purpose. It is a byproduct. It is an afterthought. It comes out of the ground mixed in with massive deposits of lead, zinc, and copper. This creates an incredibly dangerous inelasticity in the market. You cannot simply instruct a massive mining conglomerate to produce more silver just because the price spiked to $120. They are a copper mine. To get more silver, they have to mine and process millions of tons of more copper. And here is the terrifying paradox. If the broader global economy is slowing down, if construction in China is stalling, if the demand for industrial base metals like zinc and copper falls, those mines reduce their output. And when they reduce their copper output, the silver supply gets choked off entirely by accident. The silver literally stays locked in the ground, regardless of how high the price goes. The primary silver producers, the rare companies that actually focus primarily on the white metal, are currently experiencing a massive, unprecedented margin expansion. Their all-in sustaining costs are sitting around $34 an ounce. With the price at $75 today, they are generating incredible cash flow. But they are small. They cannot physically increase their output fast enough or large enough to flood the market and stabilize the price. We are left with a violently unstable environment. The physical supply is genuinely constrained, brittle, and incredibly difficult to expand. Yet the industrial demand is actively and aggressively shrinking itself to survive. This push and pull dynamic creates an incredibly dangerous, volatile environment for the average person putting their hard-earned money into the market. This brings us to the most gripping and potentially devastating part of the narrative. What happens next? How does this play out for the people watching this video? This is where you must remain fiercely vigilant. The institutional analysts at Bank of America have recently issued a forecast that is being widely circulated. It is a forecast that sounds incredibly bullish on the surface, but if you look closely, it is a brilliantly disguised speculative trap. They are publicly forecasting that silver could rally back up to $100 an ounce in the fourth quarter of 2026. If you are just scanning the headlines on social media, you might jump out of your chair, grab your wallet, and start buying every single ounce of physical metal you can get your hands on. You might think the bull run is back on schedule. But if you read the fine print, if you demand the real information, which is the sole mission of this channel, you will see the jaws of the trap waiting to snap shut. These massive institutions believe this projected Q4 rally will be driven almost entirely by sheer momentum and algorithmic trading. They anticipate that gold will make another massive surge later this year, driven by resurgent inflation fears, escalating geopolitical chaos in Eastern Europe or the South China Sea, or the sheer inability of the Federal Reserve to tame the spiraling United States debt crisis. When gold runs, the algorithmic trading bots and the massive speculative hedge funds will violently drag silver up with it. It will be a sympathy rally. It will be built on hot, fast money, not on solid industrial fundamentals. And the absolute second that momentum fades, the moment gold catches its breath, the floor will fall out from under silver faster than you can blink. Because the underlying industrial base has been so severely weakened by the solar industry's thrifting, there is zero fundamental support for silver at $100. Bank of America predicts that after hitting $100 in late 2026, silver will collapse back down to $75 an ounce or even lower by the second quarter of 2027, as the cold reality of the shrinking deficit finally overrides the speculative frenzy. I want you to deeply imagine the psychological toll this takes on the everyday retail investor. Imagine the human cost. You believed the narrative. You bought silver at $110 in January. You suffered through the agonizing, sleepless nights as you watched it crash to $75 in May. You gripped the table, you held on through the pain, refusing to sell at a loss. Then, November arrives. The price spikes back to $100. Your heart races. You think, this is it. I was right. Next stop, $150. So you hold. You don't take profits. And then, slowly, agonizingly, like air leaking from a tire, the price bleeds back down to $75 by the summer of 2027. You have achieved nothing. You have effectively trapped your precious capital, your stored human labor, in a highly volatile, non-yielding asset for 2 years, all while the silent fief of inflation continues to eat away at your purchasing power at the grocery store and the gas pump. This is what happens when you misunderstand the mechanics of the market. The market is a machine. It is completely, utterly devoid of empathy. It does not care about your retirement plans. It does not care about your profound belief in the impending collapse of the fiat currency system. It does not care that you think silver is God's money. It only obeys the brutal mathematical laws of supply, demand, liquidity, and leverage. Now, you must not misunderstand my message today. I am not standing here telling you that silver is dead or that you should rush out and liquidate your entire physical stack. Far from it. I am a realist, and the reality of the 2026 landscape is deeply, fascinatingly nuanced. While the massive solar industry is actively destroying demand, other powerful, unstoppable forces are fighting a brutal tug-of-war to keep the silver market tight. We absolutely cannot ignore the sheer scale of the artificial intelligence revolution. The massive hyperscale data centers required to train and run the advanced AI models of 2026 consume an almost incomprehensible amount of electricity. We are talking about power requirements that rival small nations. To build these data centers, to massively upgrade the aging global electrical grid to handle these unprecedented loads, and to manufacture the millions of specialized, high-efficiency semiconductors required, you need silver. There is currently no synthetic substitute on the planet that can match silver's thermal dissipation and electrical conductivity properties at scale. Every single time humanity demands faster processing power, every time we push the boundaries of AI, we demand more silver. Furthermore, we must cast our eyes to the east. The geopolitical and economic gravity of the world is shifting, and India is proving to be a colossal force in the physical market. India, historically one of the world's most ravenous consumers of physical silver for both heavy industrial use and deep-rooted cultural purposes like jewelry and massive wedding dowries, has re-entered the market with unprecedented force. Following the start of their new financial year, they reopened their bullion imports, unleashing a massive pent-up backlog of demand. We are currently watching a historical migration of wealth as millions of ounces of physical metal are being actively drained from the LBMA vaults in the West and shipped directly into the hands of Eastern consumers who view the metal as true generational wealth. These factors, the AI infrastructure boom and the insatiable Eastern demand, are acting as a massive concrete floor beneath the price. They are the exact reason silver is trading at $75 today and not collapsing back to the $25 levels we saw in the early 2020s. The structural demand for the electrification of the globe is permanent, but the critical, multi-million-dollar question you must ask yourself is this: is the steady growth in AI and grid demand strong enough and fast enough to fully offset the massive, sudden reduction in solar demand caused by high prices? The cold, hard data right now suggests that it is not. It is not enough to maintain the massive, panic-inducing supply deficits we saw in 2024 and 2025. The deficit is actively shrinking. The physical market is finally catching its breath. So, how do we navigate this minefield? How do we protect our families, preserve our purchasing power, and maintain our absolute sanity in a market that is flashing such violently contradictory signals? Here on Aurex, we do not peddle fear, and we do not sell hopium. We believe in actionable, grounded intelligence. You cannot control the algorithms of Wall Street, and you cannot control the price of commodities. But you have absolute control over your exposure, your psychology, and your strategic positioning. First, you must immediately de-romanticize the metal. Stop treating silver like a religion or a guaranteed lottery ticket. It is an industrial commodity that possesses a monetary historical premium. That is all it is. If the underlying industrial data changes, if the solar industry invents a way to use 20% less paste, your investment thesis must dynamically change with it. Do not fall deeply in love with your bags. Loyalty to an inanimate object will bankrupt you. Second, you must obsessively watch the gold to silver ratio. Currently, as of late May 2026, it is sitting dead center around 59.1. This mathematical ratio is your compass in the storm. It tells us that right now, silver is neither historically cheap, which typically happens when the ratio spikes above 80, nor is it historically expensive, which occurs when it drops below 40. It is hovering in a neutral, dangerous no man's land. Professional wealth managers use this ratio to dictate exactly when to mathematically swap between the two metals, accumulating more ounces over time rather than blindly guessing at fiat dollar prices. Third, you must mentally and financially prepare for the Q4 head fake. If the institutional analysts at Bank of America are correct, and we witness a massive speculative spike back toward $100 later this year, you must recognize it for exactly what it is: a fleeting momentum trade driven by gold's coattails, not a permanent new plateau supported by industry. If you find yourself heavily over-allocated in physical silver, that sudden price spike may be a profound gift from the market. It may be your absolute best window of opportunity to trim your position, lock in your gains, and rebalance your portfolio into yielding assets, real estate, or stronger, less volatile hard assets. Fourth, strictly monitor the institutional outflows. Pay very close attention to the massive silver exchange traded funds, the ETFs. Right now, ETF physical holdings are actively contracting. The massive institutions are bleeding metal. They are not providing the active multi-billion-dollar capital support required to maintain a sustained, permanent breakout. Until the big institutional money returns to the table, silver will remain entirely susceptible to violent, stomach-churning downdrafts. Finally, if you are seeking explosive leverage, focus your eyes on the primary miners. If you fundamentally believe in the long-term, decade-out tightness of the supply chain, the primary silver miners who are successfully pulling metal out of the ground at $34 an ounce are generating absolute cash flow fortunes, with the price sitting at $75. They offer incredible leverage to the underlying price of the metal without the frustrating premium decay of holding physical bullion in a sideways, stagnant market. However, you must understand that mining stocks carry severe, inherent operational and geopolitical risks. A mine can flood. A government can nationalize an asset. Tread very carefully and diversify your bets. My friends, the absolute core reason I started Aurex, the reason I sit down in front of this camera and record these deep dive documentaries for you, is because I intimately understand the heavy emotional weight of finance. When we look at a digital chart, it is too easy to just see green and red candles flickering on a screen. But we must never forget that every single one of those movements represents raw human energy. It represents the exhausting sweat of a miner pulling ore from the Andes Mountains. It represents the intense, ulcer-inducing stress of a supply chain manager in Shenzhen trying desperately to source conductive paste to keep a factory from going bankrupt. And it represents you, the hardworking individual trying to navigate a complex, chaotic world where fiat currency loses its purchasing power every single time the sun rises. You are just trying to find a safe, honest harbor to park the physical representation of your labor and time. Silver flashed a blinding warning sign this month. It told the entire world that there is a strict, unbreakable limit to how fast and how high a price can rise before the real physical world aggressively pushes back. The world desperately needs silver to build the future, yes, but it absolutely cannot and will not afford it at any irrational price. The shrinking global deficit, the frantic thrifting in the solar industry, the stark, calculated warnings from the world's largest institutional banks. These are not random noises. These are the quiet, undeniable whispers of the market. They are telling us, clear as day, that the easy, euphoric money in silver has already been made. We are now officially entering a complex, highly volatile, and deeply technical phase of long-term price discovery. Do not be the tragic investor who ignores the dark storm clouds gathering on the horizon simply because you are too busy staring directly at the sun. We are living through an era of profound, historic economic fragmentation. Government sovereign spending is dangerously elevated, real inflation-adjusted yields are violently fluctuating, and the geopolitical map of the world is being aggressively redrawn in real time. In this brutal, unforgiving environment, successfully preserving your generational wealth requires extreme mental agility, cold emotional discipline, and an unrelenting, uncompromising commitment to the truth, no matter how uncomfortable or unpopular that truth may be. Thank you for giving me your time today. Time is the one single precious asset that we can never mine more of, and I do not take a single second of your attention for granted. If this video brought you real value, if it helped you cut through the noise and see the reality of the market a little more clearly today, please hit that like button right now. Share this documentary with someone in your life who desperately needs to hear the unvarnished truth about the precious metals market before they make a critical mistake. And if you haven't already, make sure you subscribe to Aurex. We are actively building a global community of grounded, intelligent, and wide-awake investors who absolutely refuse to be swept away by the dangerous illusions of mainstream financial narratives. I love you all. Stay incredibly safe, stay fiercely vigilant, and I will see you in the next Real Market Update. John A.G.